In the entire history of financial markets, no investor has produced a track record like this. A 66% average annual gross return, sustained over more than 30 years. Not Warren Buffett, not George Soros, not any trader on Wall Street. The man behind that number wasn't a banker. He wasn't a trader. He wasn't an economist. He was a mathematician. And his name was Jim Simons. This is the story of how a codebreaker turned professor turned hedge fund manager built Renaissance technologies, created the most profitable investment fund in history, and quietly changed what we think is possible in financial markets. Welcome to Global Finance Watch. Let's get into it. James Harris Simons was born on April 25, 1938, in Newton, Massachusetts. From an early age, it was clear he was operating at a different level. He earned his bachelor's degree in mathematics from MIT and his PhD from Berkeley, all by the age of 23. After graduation, he didn't go to Wall Street. He went to work for the National Security Agency as a codebreaker during the Cold War, applying mathematical pattern recognition to break encrypted communications. That experience, finding hidden structure in seemingly random data, would define everything he did for the rest of his life. After his work at the NSA, Simons moved into academia, eventually becoming chairman of the mathematics department at Stony Brook University in New York. He was a serious, respected mathematician. He published influential work in differential geometry, contributing to what became known as Chern-Simons theory, work that is still cited in theoretical physics today. He was, by any measure, a world-class mathematician. And in 1978, at the age of 40, he walked away from academia to start a hedge fund. Nobody in finance took him seriously. He had no Wall Street credentials, no trading experience, no finance pedigree. Just a belief that mathematical models could find patterns in markets that no one else could see. Simons started with a firm he called Monometrics, later renamed Renaissance Technologies, operating out of a small office in Long Island. The early years were not smooth. He experimented with commodity trading and currency markets, using fundamental analysis the way most investors did. The results were inconsistent. Simons wasn't satisfied. He believed that purely discretionary trading, making calls based on gut, experience, and analysis, was too unreliable. Human emotion was too much of a variable. He wanted a system. So he started doing something almost unheard of in finance at the time. He hired scientists. Not MBAs, not portfolio managers, mathematicians, physicists, statisticians, cryptographers, computer scientists. People who had never worked in finance and, in some cases, had never wanted to. The idea was radical. If you could gather enough historical market data and apply enough mathematical firepower to it, you could identify patterns that the market had not yet priced in. Not based on company fundamentals, not based on economic forecasts. Pure pattern recognition in price data. In 1988, Renaissance launched the Medallion Fund, a fully quantitative, fully systematic trading strategy. Algorithms placed the trades. Humans approved the system, but did not override it. And the results that followed are almost difficult to believe. Let's talk about the Medallion Fund's track record, because the numbers are genuinely extraordinary. From 1988 to 2018, the Medallion Fund generated an average annual gross return of 66.1%. After Renaissance's fees, which were famously steep, typically 5% of assets and 44% of profits, the net return to investors averaged 39.1% per year. For context, the S&P 500 averaged roughly 10% annually over the same period. Warren Buffett's Berkshire Hathaway averaged around 20%. The Medallion Fund nearly doubled Buffett's returns over 3 decades. In 2008, the year of the global financial crisis, when the S&P 500 lost 38.5% of its value, and nearly every major hedge fund collapsed or suspended redemptions, the Medallion Fund returned 98.2%. It made nearly 100% in the worst market year in a generation. Between 1993 and 2005, the fund had only 17 losing months out of 144. That's not a typo. In over 12 years of trading, they lost money in fewer than 15% of months. The Medallion Fund has earned more than $100 billion in total trading profits since inception. Simons himself was worth an estimated $31.4 billion at the time of his death, making him one of the wealthiest people on the planet. Not from inheritance, not from building a consumer brand, but purely from trading. So how did they actually do it? The honest answer is that the full details are still secret. Renaissance is one of the most secretive firms in the world. Employees sign ironclad non-disclosure agreements. The actual models have never been published. No former employee has ever fully explained how the system works. But here's what we do know. Renaissance built its edge on data, enormous amounts of it. They gathered decades of historical price data across stocks, bonds, currencies, commodities, and derivatives. Far more data than anyone else was using at the time. They then applied statistical models to find repeating patterns and anomalies that human traders had missed or couldn't process fast enough to act on. The system executed between 150,000 and 300,000 trades per day, often holding positions for very short periods. This is not long-term value investing. It's a high-frequency, high-volume statistical arbitrage machine, profiting from tiny inefficiencies over and over at massive scale. What made it different from other quant funds wasn't just the math, it was the culture Simons built. He hired people who were obsessed with the problem of finding signal in noise, people who treated the market like a scientific puzzle. And he gave them the resources, the freedom, and the time to work on it without the short-term pressure that drives most of Wall Street. The fund was also closed to outside investors by the early 1990s. Only Renaissance employees could invest in Medallion. That meant the people running the models had their own money on the line, which focused the mind considerably. Here's the uncomfortable truth for anyone hoping to replicate what Simons built. You can't. And I don't mean that as a knock on your intelligence or ambition. I mean it structurally. The Medallion Fund's advantage was built over decades on proprietary data, using models that have been refined by hundreds of the world's top scientists, running on infrastructure that no individual or small firm could match. The patterns they traded on were often so small that they only became profitable at the volume and speed Renaissance operated. Retail investors don't have access to that data, that computing power, or those models. And even if you could build something similar, the signals Renaissance found may have already been arbitraged away by the time anyone else discovered them. What Simons built wasn't just a fund. It was a scientific institution dedicated entirely to one problem. And the 30-year head start they have on everyone else is not something that can simply be bought or reverse engineered. That said, the philosophy behind it is deeply instructive, even if the system itself isn't replicable. There's another dimension to Jim Simons that often gets overlooked in the coverage of his trading genius: what he did with the money. Simons described his life as having three phases: mathematician, investor, philanthropist. And he pursued all three with the same intensity. In 1994, he and his wife Marilyn founded the Simons Foundation, which has since become one of the largest private funders of basic science in the world. Over 3 decades, the foundation supported research in mathematics, physics, life sciences, and computational science. The kind of fundamental research that doesn't have an obvious immediate application, but underpins nearly every major scientific breakthrough. Simons gave away an estimated $4 billion during his lifetime. His foundation funded research into autism, the origins of the universe, and cellular biology. He endowed mathematics departments. He paid for telescopes and genome sequencing projects. He said, simply, that he wanted to support the kind of science he believed in. Science done out of curiosity, not immediate commercial gain. Jim Simons died on May 10, 2024, at the age of 86. He had been, by any objective measure, the most successful investor in the history of financial markets. But the people who knew him said that wasn't what he cared about most. So what can the rest of us take from the story of Jim Simons? Not a trading system, we've established that, but a few principles that are genuinely useful. The first is that unconventional backgrounds produce unconventional results. Simons hired people with no finance experience and gave them a hard problem. His own lack of Wall Street conditioning was not a liability. It was an advantage. He was willing to question assumptions that everyone in finance took for granted. The second is that process beats intuition at scale. Simons didn't trust his gut. He built a system and trusted the system. For everyday investors, the parallel is straightforward. Build a consistent investment process. Automate what you can, and remove emotion from the equation as much as possible. The third is that patience and obsession compound. Simons didn't build the Medallion Fund in a year. It took a decade of iteration, failure, hiring, and refinement before the models really worked. The extraordinary results came from extraordinary commitment to the craft over a very long time. And the fourth, perhaps the most underrated, is that intellectual honesty matters. Simons was relentless about testing whether his models actually worked. When something stopped working, he threw it out. He didn't fall in love with theories that the data didn't support. That level of rigor is available to any investor willing to practice it. Jim Simons was a mathematician who looked at financial markets the way he looked at every other complex system, as a set of patterns waiting to be found. He found them. He built one of the most remarkable institutions in the history of finance. And then he turned around and gave billions of dollars to science, because he believed understanding the world mattered more than keeping score. The man who cracked the stock market spent the last chapter of his life trying to crack the universe. If this video gave you a new way to think about investing, or just a story worth knowing, hit subscribe. We cover the most fascinating figures and ideas in global finance every week. And drop a comment. What surprised you most about Jim Simons? I'll see you in the next one.